Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Richtech Robotics.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. With Richtech Robotics, the main story here isn't just about small growth. It's about a really radical, very deliberate pivot.
A pivot, okay.
Yeah, they're in the middle of this massive strategic shift. They're trying to completely redefine who they are, moving away from just selling hardware one time.
And moving towards that service model. Right. I see they're calling it Robotics as a Service, or RAA.
Exactly. RAS. It sounds a lot like the SaaS model that totally changed the software world.
It does, but this feels way more complex. I mean, you're talking about physical robots, industrial automation. That adds a whole other layer of, well, opportunity, I guess.
It does. And the goal is clear. Lock in those predictable, recurring revenue streams with what they call multi-year service agreements, MSAs.
Okay, so this whole transition is really the core of the story then.
It is. But when a company does this, when they stop booking all that revenue up front from a big sale and start, spreading it out over years,
The top line has to take a hit. An immediate, unavoidable drop.
that's it. It is the definition of short-term pain for long-term gain.
And we definitely saw that pain in the third quarter of 2025. That strategic choice led to an 18.4% drop in revenue year over year.
It did. And for any investor who's just laser focused on that quarterly growth number, that could look like a huge red flag.
So how do you convince them it's not? How do we know this isn't just management spin trying to cover up for a failure to sell their products?
That's the key question, right? And the answer is in the margins. You have to look at the margins. If this was a sales failure, you'd see those margins getting crushed.
But that's not what's happening at all.
Not even close. The fundamentals are telling a completely different story.
They're not just different, they're kind of shocking. I was looking at the Q3 2025 results, and their gross profit margin hit 74.4%.
74.4%. That's the number. That is a figure you just do not associate with a company that makes and manages industrial hardware.
No, you don't. That's software level margin.
It really is. And it's up, 410 to 420 basis points from last year? Just think about the industry. Most of these automation companies, the ones selling hardware, they're lucky to break 30 or 40%.
So a margin that high, it must mean the value isn't really in the physical robot anymore.
Precisely. The value is overwhelmingly in the software, the service, the data that they provide. Through that RAS subscription, it just completely changes the profit calculation.
And this kind of margin is only possible if you have a really healthy financial structure to back it up during the transition.
And they do. Their balance sheet looks almost aggressively healthy. They've got an extremely low leverage ratio of just 1, so very little debt.
And the liquidity is kind of eye-opening, a current ratio of 120.2.
I know. That number is just dramatically outside the norm. Some people might even argue it's too high, that they're sitting on too much cash.
But in this context, with this huge pivot they're trying to pull off, that liquidity is a massive cushion, isn't it?
It's the bedrock. It's what lets them absorb that revenue dip and fund all the investment they need. And, the market is starting to see that this strategy is actually paying off.
We're seeing it in the analyst revisions.
Yep. Guidance is being revised upward. They're projecting a clear path to narrowing those losses. The consensus shows a loss of 15 cents a share for 2025.
And that shrinks down to just 10 cents for 2026. So the unit economics are improving. The RAS model is working.
Exactly. Okay, so let's move on from the financials for a second and talk about their competitive advantage, their moat.
Right, because they're not just changing their business model. They're trying to build something really defensible with their tech, this AI cloud platform, or ACP.
And their goal of becoming the first robotics super operator. That's the key phrase.
The super operator. What does that actually mean in practice?
It's about having a central brain, one that doesn't just manage one robot at one site, but thousands of different robots across countless locations, all learning and optimizing at the same time.
So it creates a network effect. Every single thing one robot does feeds back into the system and makes every other robot smarter.
That's it. It means updates, predictive maintenance, new algorithms can be pushed out to the whole fleet instantly. For a new customer, it means their robots come preloaded with all that experience.
And I'd imagine that creates massive switching costs.
Yeah.
If you're a big retailer, you built your whole workflow around this ACP.
Ripping it out to go with someone else becomes almost impossible. It's too disruptive, too expensive, the system is too sticky.
And that stickiness got a massive validation back in August of 2025, didn't it?
It did. That's when they signed that huge master services agreement, the MSA, with a top-tier national retailer.
That partnership feels like the single biggest catalyst for the stock right now. It's the proof that the RAS model is ready for prime time.
It's the inflection point. It takes them from a promising idea to a company that's actually executing at scale. That recurring revenue is about to start rolling in.
And they made sure they had the money to scale up and meet that demand.
A very smart move. They set up and later expanded an at-the-market offering agreement in August.
The ATM offering. It lets them issue up to $100 million in stock.
Right, but not all at once. That's what's so clever. They can just drip shares into the market to raise cash as they need it to build and deploy all these new robots for the MSA. It avoids a big, stock-crushing secondary offering.
Okay, so the story is compelling. But now we have to flip the coin. Let's talk about the major risks that could derail this whole thing.
And there are two big ones. The first, and maybe the most immediate, is the huge jump in operating expenses.
The G&A surge. I saw that.
Yeah.
General and administrative expenses are up by over $10 million year over year in the 9-month period. That's a massive burn rate.
It is. Now, management will tell you it's necessary investment. Hiring engineers, building out the support structure for that super operator role.
But that spending has to be justified by revenue, and soon. If that MSA revenue is delayed for any reason,
that expense base becomes a huge problem. It could completely reverse that path to narrowing losses we just talked about.
And that leads right into the second big risk, which is customer concentration.
Yes. Right now, everything hinges on that one single retailer, that one master services agreement.
Which is great for validation, but it creates this acute risk. They are so vulnerable to the whims of just one partner. What happens if that retailer changes its strategy or hits a rough patch?
The fallout would be severe, not just on the revenue, but on market confidence. It would just completely erode the whole thesis.
So they have to show, quickly, that they can replicate this deal with other major players.
Absolutely. The first one has to become the template, the bulletproof case study to land the next one, and the one after that.
All right, shifting gears a bit, how is the stock price actually reflecting all of this mix of short-term pain and long-term potential?
Well, technically, the stock is actually in a pretty clear bullish trend. It suggests that the bigger investors are buying into that long-term story, despite the revenue dip.
It's trading above its main moving averages.
It is. It's comfortably above the 200-day, which is down at $3.09, and the 50-day, which is at $4.77. Being above both is a strong signal.
And support seems to be holding up well, too.
Very firm. It's holding steady in that $2.80 to $3 range. It seems like anytime it dips down there, buyers step in, probably because they're optimistic about this RAS pivot.
Is there anything in the charts that suggests we might be due for a near-term bounce?
There is, actually. If you look at the momentum indicators, this STOCH 966 is way down in oversold territory at 10.03.
Okay, so that suggests the recent selling pressure might be exhausted.
It does. For technical traders, that's often a signal that a bounce could be coming. Based on all that, analysts are projecting a bullish range for the next 3 months.
And what does that range look like?
They're looking at about $3 on the low end, with a potential to reach up to $5.50 on the high end, assuming, of course, that the fundamental catalysts hit.
And speaking of catalysts, the next few months are absolutely packed with them, aren't they?
They are critical. The single most important trigger is the Q4 2025 earnings report. It's expected around December 11th.
And that's the moment of truth.
That's it. It's the first time the market will see any real revenue from that major retailer MSA. It's when we find out if the RAS transition is truly working.
And a good report there could bring in more big money.
Exactly. Right after that, in late January 2026, we get the Institutional Holdings 13F window. A strong Q4 could mean we see a big jump in institutional ownership in those filings.
Okay, so those are the known events. What about the whispers, the rumors? The robotics space always has a lot of chatter.
It does. And there's some unconfirmed market talk that the company is already in advanced talks with a second top 10 U.S. retailer.
Wow. Now that would be a game changer. It would almost completely eliminate that customer concentration risk overnight.
It would be transformational. And then on the tech side, there are also rumors swirling about some novel AI-driven robotics enhancements.
Any more detail on that?
The buzz is that it might come through a collaboration with a very large, well-known technology firm. An alliance like that could just supercharge their super operator roadmap.
So if you bring this all together,
You bring it all together, you have a company with these industry-defying 74.4% gross margins and a proprietary platform that's just been validated by a huge customer. Their entire value now hinges on one thing: execution. They have to convert that MSA into a durable, recurring revenue stream and do it fast enough to overcome the expense burn and the concentration risk.
that combination of incredible margins and a clear strategic pivot makes us a really high upside story,
Yeah.
but one where these next couple of quarters are absolutely everything. If you found this analysis valuable, make sure you hit that subscribe button to catch our next discussion tomorrow.